Good morning, and thank you for joining Thompson Hine's weekly coffee chat series. My name is Eric Miller. I'm a counsel in Thompson Hine's investment management practice group. And joining me today is my colleague, Parker Bridgeport, also counsel in the investment management practice group. I note that Parker is especially well suited to address and help demystify the focus of today's discussion, value at risk, or VaR, under the SEC's new Rule 18F4. Parker is a retired certified financial analyst, CFA, and a former fixed income and derivatives portfolio manager for registered investment companies. He's a real expert. As you all know, VaR is an important analytical tool required to be used pursuant to the terms of Rule 18F4. VaR can be affected by a number of market factors which bear upon the risks related to investments in derivatives. We will examine the key elements of VaR and the three chief methods for calculating potential losses as contemplated by Rule 18F4. Before we begin, a couple brief housekeeping items. If you have any questions or comments during today's program, we encourage you to join the discussion by using the Q&A box on your control panel. We'll try to get to those comments or questions as we move through our discussion, and we'll try to leave some time at the end to answer any that we haven't been able to address. Whether we're able to get to them or not, we promise to follow up any questions we don't get to during our time together. So with that, let's get started. Parker, the SEC's new derivatives rule, Rule 18F4, requires the use of the value at risk, VaR metric, as a key component of an effective derivatives risk management program. What is VaR, and how does it complement other features of an effective program?
Well, thanks, Eric. Just by way of a brief tidbit of background information, Rule 18F4 represents the SEC's attempt to unify its approach to limiting the leveraging effects of derivatives. In the decades that preceded the rule, the SEC's guidance was a patchwork of no action letters, other forms of guidance that produced unusually divergent results. Some of the limits were based on notional value of the derivatives, some on market value. So it produced widely varying results depending on the nature of the derivative. So here, their attempt to adopt VaR as a measuring stick or speed limit should help unify the use of derivatives across all funds. So what is VaR? Unfortunately for VaR, it's a bit of a misnomer. A better name for it might be near worst case scenario or bad return scenario. When I think of VaR, I'm often reminded of a 2014 Disney movie, Alexander and the Terrible, Horrible, No Good, Very Bad Day. The intuitive basis of VaR is to try to look at some return scenario that is unfavorable, albeit stopping short of a worst case scenario. In terms of how it interacts with the rest of a derivatives risk management program, VaR is the daily speed limits that is always percolating in the background. So all the rest of the derivatives risk management program revolves around this daily measurement of risk. So that is I guess, our intuitive summary of VaR. So Eric, back to you.
Thanks for that, Parker. So VaR is a widely used financial analytical tool, not just in the context of 18F4 or a derivatives risk management program. I understand it has multiple dimensions to it. What are the dimensions contemplated by Rule 18F4 that will better assist us to understand what is involved in the metric?
Well, thanks. VaR's got three key dimensions. One is time, the other is probability, and the other is magnitude of loss. As to time, market participants often measure returns daily, weekly, monthly, and so on. And also will use varying historical lookbacks when they're measuring returns. Under the rule, the SEC has stated that they want everyone to use 20 trading days as the relevant time period and want the funds to look back at least 3 years in history for computing their VaR. Now, in terms of probability of loss, or sometimes called confidence interval, the SEC stated that it wants funds to use 1% as the dividing line for the probability of returns. And by that, they mean they want funds to identify the 1% and worse returns as compared to the rest of the returns of a fund or a stock or an index that represent the 99% better return. So SEC wants funds to use a very extreme measurement of probability of loss. Then in terms of magnitude, this is the so-called line in the sand that divides the returns that represent the 1% worst returns from the other 99% returns that are better. So those are the three key dimensions of VaR.
Okay, thank you for that. VaR can be used in a variety of financial analytical models for various purposes. Rule 18F4 contemplates 3 different analytical models of varying complexity. Please describe them for us and discuss how they are relevant in the context of 18F4 and the analysis required under it.
Oh, thanks, Eric. Yeah, the SEC recognizes 3 approaches to calculating VaR. One is the pure historical approach. As it sounds, you just look at your sequence of 20 trading days at a time, look back in history, tally up the returns, and then rank them, and you'll find the 1% worst return is the bottom of the stack. They've also recognized that folks may want to use what's called a parametric approach, and that's a statistical term that just invokes the notion of using the average return and then subtracting off returns using the standard deviation until you get to the statistical measure of the minus 1% barrier. So for example, if you took the average return, subtracted off 2.33 standard deviations of those returns, that lands you at the 1% dividing line based on a pure statistical approach. The SEC also recognized a Monte Carlo approach, there the name being a nod to the casinos of Monte Carlo and the randomness of outcomes at the gaming tables. Here I'll note that any Monte Carlo approach is a very complex sort of witch's brew of statistics that are stirred together to produce an analysis. For the time being, we'll deem the Monte Carlo approach beyond the scope of today's discussion. So that said, that gives us sort of an intuitive approach to VaR, its 3 dimensions, and the permissible models. Maybe by way of example, I'll just note that the SEC will allow funds to use either a relative value approach or an absolute value approach on VaR. We expect most folks to use a relative approach, and that is the rules states that your securities portfolio plus your derivatives has to have a VaR that is less than or equal to 2 times the VaR of a reference portfolio. So by way of example, let's just say that your reference portfolio is the S&P 500 index. If we used a pure historical approach to calculate VaR, we took 20 trading days and examined 100 of those going back in recent history, we'd find that the VaR of the S&P 500 index is approximately minus 12%. So that would be representative of the dividing line between the 1% worst returns and then the rest of the returns. So that hopefully gives some sort of handy reference point. I think that most folks think of VaR on the S&P 500 as what was a bad month for the S&P 500. In this case, the dividing line would be approximately minus 12%. So that said, maybe an example of how VaR fits in to a portfolio manager's calculations would be handy. For this purpose, we'll note that whenever you're computing relative VaR, you've got three key elements. One, that is the VaR of your securities portfolio, the VaR of your derivatives, and the VaR of your reference portfolio. So in a simple example, let's say that you were a large cap equity stock manager and you wanted to use S&P 500 futures to dial up your market exposure, and that your relevant reference portfolio for purposes of the rule was the S&P 500 index itself. So you've got three very similar items moving together. In an oversimplified example, we'll assume that both the futures and the index in your portfolio all had the same VaR of minus 12%. In that scenario, under the rule, you would be allowed to add $100 notional S&P 500 futures exposure to a $100 stock portfolio and still be within the limits set by the rule. Now, in a more flexible scenario, let's say that you were a large cap stock portfolio manager, but you were extremely astute, and there your historical VaR was only 6% on your portfolio. You managed to avoid the big losses that were dealt to most market participants. Under that scenario, you'd have a lot more flexibility to add on futures to your position. So there you could have a $100 stock portfolio, $150 of notional futures exposure, and still be within the limits set by the rule. Now, in a scenario where you were maybe not a very good stock picker, or you invested in more volatile stocks, let's say you had a scenario where your stock portfolio had a VaR of minus 18%, and again here your futures and your S&P 500 index both shared the minus 12 as their VaR. Here you would, if you had a $100 stock portfolio, you'd be limited to $50 of notional futures exposure. And again here, all these methods take the VaR of your securities portfolio, add on the VaR of your derivatives, and compare it to 2 times your reference portfolio. So hopefully that provides something of a base case, simple comparison for the nature of VaR, how it fits in with the rule, and how folks might anticipate using it. Now, I believe probably most folks will face a far more complex feature than our simple example of large cap stock portfolio plus S&P 500 futures, but hopefully that gives some sort of guidance by way of example. So Eric, I'll turn it back over to you.
Yeah, so this all sounds very contextual to me. And it would seem to me that complexes are going to find that one model may be more appropriate for their operation than another. Putting on your former portfolio management hat and being the seasoned 40-act lawyer that you are, which of these approaches in the abstract, recognizing we don't have specific context, but in the abstract, would you think would be most helpful given the purposes that are intended to be served by ATF?
Now, that's a very interesting approach. I suppose if you're the portfolio manager, you are looking for the combination of models and measures that produce the fewest constraints on you. Looking at our brief survey of various indices, reference portfolios, and the like seem to suggest that a pure historical approach will produce the biggest VaR numbers for the reference portfolio and give you the most flexibility. So on our, jumping back to our earlier S&P 500 index example, that the pure historical approach produced a VaR approximately -12. In that scenario, the parametric approach would have produced a considerably lower VaR in the neighborhood of -9%. That in turn would constrain the portfolio manager who is trying to stay below the 2 times limit on the reference portfolio. I also note that for very complex portfolios, you may see folks adopting a Monte Carlo approach, because there you've got tremendous amount of flexibility in terms of how you would cast the correlations between asset classes, the reference portfolio, the standard deviation of returns, as well as the cross correlations across all returns. So I think that you will probably see a fair amount of delving into approaches to generate the one that gives the most flexibility to the portfolio manager. Now, that said, that's not intended to suggest that people should, try to game the system or, get around the rule. But I would expect that based on all the SEC's guidance, I'm thinking that they were expecting that most folks would take the parametric approach, where you just look at the average returns and subtract off some standard deviations, and that generates your line in the sand for establishing your VaR, upon which your relative VaR is then judged.
Very interesting. Suffice it to say, he knows this stuff really well, and we're so happy to have him when these issues come up in-house. VaR is an arcane financial tool. It's going to be familiar to only a minority of fund directors, which may have relevant experience. Given that limitation and VaR's importance to an effective 18F4 program, what role does the SEC expect directors to play in its administration? And in particular, does a fund director have to become an expert in the math underlying VaR in order to discharge its duties under the rule and other applicable law?
That's a very interesting question. Based on the rule, as well as both the proposing release and the adopting release, the SEC has made it clear that the trustee's role, as is the case in most of its endeavors, is one of oversight. The trustees are not tasked with approving the specific derivatives risk management program. However, they are tasked with approving the derivatives risk manager, which in most cases will be an officer of the advisor. So there, the trustees' key decision will be, do they have confidence in the derivatives risk manager such that they reasonably believe the derivatives risk manager understands the rule, has constructed the appropriate measurements of VaR on the portfolio derivatives and reference portfolio, and will the derivatives risk manager be able to report in a timely fashion if something should go wrong? The derivatives risk manager is only required to make a report of the initial derivatives risk management program and provide an annual report thereafter. The rule also contemplates some corrective measures to be directed by the derivatives risk manager should the relative limits be exceeded. So I'm anticipating that most of the trustees will rely on an oversight approach and will likely ask for quarterly reporting at the normally occurring quarterly meetings from the derivatives risk manager. But again, here, there's no anticipation of any math test for the trustees. They're, again, just an oversight role informed by a reasonable inquiry.
So it sounds like the approach here is very similar to what a trustee is expected to do in respect of lots of complex things that are part of the operation of a mutual fund. delving into the details of a derivative contract or an algorithm that is used for some sort of specialized fund. So that if I understand you, they need to be looking to their standard duties under state law and the 40 Act as fiduciaries to get informed, stay informed, ask appropriate questions, so that they can reach an informed, reasonable business judgment. I think the SEC actually recited that requirement in the release. And, certainly they'd be permitted to reasonably rely on their experts. And those experts include the derivatives risk manager. And I think most trustees take great comfort in this, turn to their counsel, because they will be able to, in the context of a particular question, of a particular requirement, help the trustees sort through what they need to think about, how they need to approach a problem to build the record to establish an informed, reasonable business judgment. That is the big mystery when these new requirements are adopted, and which in my practice previously vexed trustees the most. And I think there's great comfort in knowing that there's a fairly wide range of alternatives that can meet the standards of care that are required under state law under the 40 Act. And this is going to be an iterative process for everybody, counsel, trustees, and the regulators. So there isn't only one answer to that question, and it's a facts and circumstances contextual issue that should be reflected in minutes and discussions between trustees and their counsel. That's very, very helpful stuff. I see we don't have any questions at present. We'll be happy to try to field anything at this particular point. We do, okay. Perhaps we can field one or two. I think we've got a couple of minutes. Okay. Should a portfolio manager short S&P futures, the VaR of the combined portfolio would be less, but the S&P requires that the limit be assessed on the individual positions, not the combined. Does that make sense? Parker, what are your thoughts about that?
Eric, I think that's a good point. Here in this scenario, the derivative is a risk reducer, so I would anticipate that it will be of sort of little consequence in the scheme of the derivatives risk management program. Here is certainly no concern that you would exceed 2 times the VaR, the reference portfolio. Maybe in that scenario, you might even have a VaR that approaches 0.
Thank you. I hope that responds to the question. Another one. Should a board look to have at least one director that has an understanding of the math and of the derivatives that are going to be subject to the assessment? I don't believe that is required. Would it be ideal to have somebody on the board with that skill set? I think, as is often the case, directors with specialized experience can be helpful. certainly there's no requirement to do so. And I believe that as people become more familiar with the requirements and sort through its minutia, I think we'll find that we'll be able to function without a specialized director for that purpose. Well, let me see if I can do one more.
See if you can find an easy one that we can answer.
Yeah, that's why I'm struggling. What is the SEC's goal in requiring a VaR methodology? Is the SEC imposing a more rigorous approach?
Generally speaking, yes, a much more rigorous approach. The SEC looked to the Investment Company Act and noted that in the act there is a limit on leverage that is sourced through borrowing, and there the limit is 150%. Or by way of example, if your fund had $100, you could borrow $50 from a bank, go out and buy more securities. And that was the touchstone that the SEC was using in trying to craft the derivatives limit. In the initially proposed release, they were suggesting a relative VaR of 1.5 times, which would have aligned logically with the Investment Company Act limit. Upon review, I think that they determined that that was so restrictive that it would be too disruptive to the marketplace and adopted the 2 times VaR limit. In terms of selecting VaR, I think it was a matter of finding one measure that could be uniformly applied to any asset class, and that was their primary motivating factor. Their prior approaches to try to use notional limits or negative trade equity proved to produce such inconsistent results that I think they had felt that VaR, while not perfect, at least was a rule that would be uniform for all participants, and that was the main reason for its selection. But just to get back to the meat of the question, it wasn't an attempt to limit derivative use. Yes, without a doubt. Under the prior guidance, by way of reference, if you wished to, you could have constructed a fund using S&P 500 futures that produced 14 times the return of the S&P 500 index, and that's certainly a degree of leverage that is far beyond anything contemplated by the Investment Company Act, and certainly beyond what was contemplated by the SEC staff.
Well, thank you very much. Unfortunately, we are at time. Much as we'd like to continue to discuss this important topic for much, much longer, and it does require extensive discussion and assessment, we're very mindful of everybody's busy schedules. So that concludes today's chat. An announcement: our next coffee chat will be held on Wednesday, June 23rd. My colleague Mark Miner will be joined by Bill Riley from Oyster Consulting, and they'll be discussing how best to handle regulatory inquiries and best practices for advisors to consider before the examiner shows up at your doorstep. They will share their insights on the mock exam process and why it is an invaluable tool in preparation. To register for this or future coffee chat discussions, please visit the events page on the Thompson Hines website. And we encourage you to view our library of past coffee chat recordings, which are available on Thompson Hines' YouTube channel. We want to thank you all for attending today's program, and special thanks to our consummate expert, Mr. Bridgeport, for sharing his insights. When the webinar ends, you'll be prompted to take a survey, providing us with some valuable feedback. We really appreciate feedback and learn so much from it. It's a gift. Thanks again, and enjoy the rest of your day, and stay well, please.